Just getting the camera straight there for everybody. And good afternoon. Good afternoon here in Southern California. This is Neil Palache with the Wealth Creator Company for Women. And it is 5 o'clock on the west coast of the United States for those of you who are outside of the country or in other parts of the states. That is Pacific Standard Time. And thank you for all the hearts. I couldn't imagine who those are coming from. I think that might be my friend who's named after a piece of fruit. But anyway, it's good to see you. Actually, it's good for you to see me because I cannot see you at all. But I'm happy to be here. And we are going to talk today about your life insurance plan. Now, for those of you who know me, you'll already know what I'm about to say, but for those of you who don't, you may not know that I was in the business of selling life insurance for, about 25 years. Now, I know that that is hard for you to believe, given how young I look. How could a man that looks this young possibly have sold anything for 25 years? Well, obviously, I started when I was a very young teenager. And I'll let you just go with that for now. Go with that for now, okay? So here is the deal with life insurance. It is quite complicated, but at the same time, very simple. I know, isn't that kind of a ridiculous thing to say? Well, because here's the deal. The deal is that the number one reason for buying life insurance is because you have somebody that you want to protect. The reason it's called life insurance is because it's for the people who are still alive. There's a reason that they don't call it death insurance. Well, there's two reasons. Number one, that would be a horrible thing to call it. And number two, because it has nothing to do with the dead person. It has everything to do with the people that are still alive. So the number one reason to buy life insurance is because you have somebody that you care about, that you want to protect in the event that something were to happen to you. And you want to pay off debt, replace income, replace a key person, buy someone out of a business, pay estate taxes. There is something to protect. Now, I know that over the years there has been a ton of discussion and some pretty good reason to buy life insurance for other purposes. I get it. Now you can buy life insurance that combines life insurance with long-term care insurance. Long-term care riders can be added. Life insurance can be purchased for building wealth. No question about it. Some of the life insurance programs out of there that you've all been exposed to have tremendous cash value or equity growth opportunities. But I have to say that I still believe to this day that the purpose of life insurance is to protect somebody in the event of your death, somebody that is still alive, your spouse, your children, and so forth. It is not for purposes primarily to accumulate wealth. But we're going to talk a little bit about that. So, number one, I'll give you an example. I was talking to somebody on the phone this morning, and this was just somebody essentially that was talking to me just from an advisory standpoint. And husband and a wife and two young kids, and she was being shown a cash value life insurance policy, spending about $100 a month, and it only had about $50,000 of death benefit. And I said to her, look, you have an income and your husband has an income, so the first thing that you have to look at is you have to look at the replacement of that income in the event that something were to happen to one of you. And they had about $260,000 of a debt in the form of a mortgage, and maybe you'd want to have that paid off if something were to happen to one of you. So the very first thing you want to do is make sure that you have enough life insurance. in their case, hundreds of thousands, at least let's say 500, 600, $700,000 of capital would be required to replace each of their incomes if something were to happen to one of them. And so therefore that's the number one thing. And they had like $100 a month to spend, so you're not going to buy a lot of equity-based life insurance for $100 a month. You've got to buy term insurance. And what is term insurance? I know you're all screaming at your phones right now, just like you would scream at the television. I cannot hear you. Anyway, term insurance is that insurance that only pays in the event that somebody dies. It insures one person for one death per lifetime. That was actually somewhat comical, but to move right along, one life insurance policy on one person, and it is the least expensive way to buy life insurance today. Now, what I mean by that is if, let's say, you're 40 years old and you can buy $500,000 of life insurance for $30 a month because you're a healthy, preferred non-smoker, and if you're female, maybe even less than a male, because females typically live longer. It's all based on life expectancy, right? So how many 40-year-olds are actually going to die when they're 40? Not many. So you don't have to charge too much in order to cover that risk, and that's essentially how it works. If, on the other hand, that person was 80 years old, how many people die when they're 80? Well, a hell of a lot more than people when they're 40. So you have to charge a lot more. By the way, in many cases, you can't even buy term insurance as an 80-year-old because the life expectancy of that person may only be a few years, even if they live 20. The life expectancy, meaning the average that an 80-year-old male or female will live once they are 80. What is that? 3, 4, 5, 6, 7 years. If that person lives 20, great. But for the averages, it's a heck of a lot less than that. So term insurance is typically purchased by people that are younger. Term insurance is typically purchased by people that have little amounts of money. Term insurance is purchased by people that have large insurance needs but a little amount of money. And term insurance is purchased by those people who just don't want to accumulate cash value in a life insurance vehicle. And you can buy term insurance for 10 years at a time, 20 or 30 years at a time. You can buy the equivalent of a term life insurance policy even for a lifetime. As a 50-year-old, you can buy it for 50 years. It's actually on what's known as a universal life chassis, and it just acts like term insurance for all intents and purposes. Now, if you say, well, I would like to do something a little different, and in fact, not only do I need a lot of insurance, or no, I need not that much, but I have a pretty healthy budget. I can put $300, $400, $500 a month away, and I like the idea of putting it into life insurance because I understand that it has tax-deferred features. You don't pay taxes on the gain, that the death benefit in most cases still remains tax-free, and if I am well advised, I can take the money out of that policy at the other end on a tax-favored basis. Some people say on a tax-free basis, and you got to, be careful with your wording, but you can take the money out without paying any tax. The thing that you have to make sure is once you've taken the money out, that policy remains in effect for the balance of your life until you die, in other words. Otherwise, all of the tax gain that could have been due in that policy will now be due in that policy if it lapses before you die. And that's a very, very important part of the equation when you're looking to accumulate money. But it is a great way to accumulate money for many people in certain circumstances on the assumption that you are first properly insured. You've got to be properly insured first. And of course, when you buy those kind of life insurance policies, you have universal life, you have indexed universal life, you've got variable life, and you've got whole life. There are some additional hybrids. You can buy whole life with term insurance mixed in. So there's a couple of hybrids out there. But the basic four types are universal life, index universal life, variable life, and whole life. You might actually put whole life at the beginning if we were going to use a risk tolerance value in terms of how we were to place them in order. So the whole life would be considered the most conservative. The universal life would probably be considered the second most conservative. The index universal life, which is very close to both the whole life and the universal life, would be considered the third most conservative, and then the variable would have the most risk. The variable is invested, the money that you have, the cash value, equity that you have in that policy, is typically invested or can be invested in the stock market. There's often bond choices and maybe even some other choices, a gold fund and some other things, depending on the insurance company that's issuing the contract. The IUL is the index universal life, is not invested directly in the stock market, but is given its returns by how the stock market reacts. In other words, when looking at an index, which is why it's called index universal life, when you look at the index like the Dow, the NASDAQ, and so forth, you say, well, how did that index do? Oh, it went up 8%. Okay, then we will give you 8%. Now, it's a little bit more complicated than that because sometimes they will have maximums, maybe 5 or 6%. So if it does 8, you may only get the lower of the maximum and what the index actually did. So you've got to look very carefully at how that contract works, but it can be very favorable. And then universal life, which is probably the least used product anymore in terms of funding it for equity building purposes anyway, is based upon short-term interest rates. Often that universal life is what is used as that chassis product that I mentioned when I was talking about term insurance, so that you can have a lifetime level premium, level death benefit life insurance program. Doesn't build any equity, you're insured for as long as you pay the premium, but the premium can be paid and coverage can be kept throughout your entire lifetime. And then whole life, which has a fixed premium, usually a dividend built in, with a level and possibly increasing increasing death benefit and cash value, is the most conservative and usually requires the greatest outlay of all of the programs. The universal life program, index universal and variable, often have the ability to flex the premium, to lower it, raise it, put money in, take money out. They definitely have more flexibility. The whole life typically has a fixed premium, and you've got to kind of use the money in there to help offset premiums, and it's a little bit more difficult to work with if you want flexibility. The IUL, the Index Universal Life, seems to be very popular right now because it has many guarantees in it. It has the ability to build a fairly substantial cash value. It also has the ability, however, for the insurance company to change expenses, which for instance, whole life companies can only do that through the dividends. But with the Index Universal Life contract, they can do that directly within the contract itself. They work a little differently. If you want to be knowledgeable, I would make sure that you just ask the right questions. Ask lots of questions about how these products work and what makes the most sense for you. So again, to recap, you've got your 10, 20, and 30-year term insurance. That is generally used for people who are younger, need large amounts of insurance, and have limited budgets. You also have the lifetime term, which is on a universal life chassis, has a guaranteed premium, and will last typically your entire life. Then you have whole life, universal life, indexed universal life, and variable life. Those products, if designed properly, will last your whole life. Whole life itself is designed to last your whole life, and is guaranteed to do so. The other products sometimes are, and certainly can be designed to be very attractive, last your entire life, and with the cash value that you've built in any of those 4 contracts, there is the ability to take money out as an income stream, as sometimes a lump sum benefit during the period of time that you own the policy while you're alive, so it has living benefits. It can add to things like Social Security and other benefits through IRAs and pensions that you may have, and it may, for you, be a very attractive way to build equity, to build worth, to have life insurance, and have all of it be done on a tax-favored basis. So while you may not want to put all of your assets and all of your income into those products, it's certainly worth a look, because they can be very attractive if used properly. So there you go. I try to limit these periscopes to 10 or 15 minutes. This is being recorded and will be on Periscope for the next 24 hours. I then upload it to YouTube, and I will send it out and put it on Facebook and Twitter and so forth. So if you want to listen to it after the fact, or if you want to listen to it again, you'll be able to do so. I really appreciate all the hearts. That is a good way to gain recognition on Periscope. I'm always looking to build the audience. I'm also going to be doing these talks on Facebook Live, which is another live broadcast video program now that's available as a phone app. And of course, Facebook's competing with Periscope, that is owned by Twitter and so forth. So it's all a great deal of fun. So I appreciate you being on the broadcast today. This is Neil Palache with the Wealth Creator Company for Women. Please visit www.thewealthcreatorcompany.com and subscribe to my weekly newsletter, tips and money saving options. And also on Thursday evening, for those of you who are of the female persuasion here in Westlake Village, I will be having my Women's Money Mastermind, which you will also find on my website or at www.meetup.com/Women's Money Mastermind. If all of that is too confusing for you, feel free to call me directly at 818-606-7327. 818-606-7327. Have a great week, and I will see you next Monday at 5 p.m. Thanks.